Hey, Tony Abate here with Ross Mortgage. So you're getting a new mortgage, and the loan officer is throwing around that term escrow account. What in the world is that loan officer talking about? We're going to cover that a little bit. In fact, we're going to cover three things this afternoon. What is that escrow account? Do I have to have one? And how does it work? Our industry does a really good job about talking about interest rates and fast closings and the exciting stuff. Escrow accounts are kind of pushed off to the side, but it's an important topic because it ties up a good chunk of your money. This will be either for a purchase transaction or for a refinance transaction. You need to know how this works. So what is an escrow account? An escrow account, sometimes called an impound account, depending on where you're located, is nothing but an account that holds money, your money, to pay future bills, specifically taxes and insurance. You don't pay any interest to have the escrow account. You don't earn any interest to have the escrow account. I have my Happy Meal bucket here because this is a really good example of how an escrow account is going to work. Money is put in and money is pulled out as bills come due. Simple as that. So do you even have to have an escrow account? If you are purchasing a new home and you are putting less than 20% down, chances are you're going to have an escrow account. It is required in most cases when you have that smaller down payment. If you are making a 20% down payment or more, it's optional. You can have one if you want. You're not required to have one. Sometimes people ask, what's the better decision? And what I like to tell folks is, it's a decision that's going to help you sleep at night, because there really isn't a financial benefit, a strong financial benefit, one way or another. In a year's time, you're going to pay a year's taxes, no matter how you slice it. All we're doing with an escrow account is changing how you pay, not how much you pay. So how does the escrow account work? Well, an escrow account is going to take annual expenses, and again, we're talking taxes and insurance expenses, which are billed once a year. You're going to spread that out over the course of 12 months. It's budgeting. It just makes the money a little easier for you to manage as a homeowner. Your escrow account is going to take these large annual expenses, in this case, tax and insurance expense. It's going to divide them out over the 12 months. You're going to put 1/12 of your tax and insurance in your escrow account every time you make a house payment. 1/12, 1/12, 1/12. When these annual bills come due, the bill is going to be sent to your mortgage servicer, and they're going to reach into that escrow account, they're going to reach into the bucket, and they're going to pay the bill. And that's just going to keep happening over and over and over again as long as you own the home and you have an escrow account. So a couple things to know though. When you close on a new home, you have to have a starting balance. The lender is going to require you put some money in that escrow account coming right out of the gate. And sometimes the question is, why do I have to do that if I'm paying 1/12 of my insurance and taxes in my house payment? Well, the insurance company and the taxing authority doesn't want installments. They want their full bill paid when it comes due. It's as simple as that. So the other thing to know is that when you close on a new home, your tax bill and your insurance bill is not going to be 12 months away. It's going to happen sooner. I'm recording this in October. So if somebody closes on a home here in Michigan in October, they're going to have a winter tax bill with the due date of December 1 coming right out of the gate, just 2 months away. And then on July 1st of next year, the summer taxes are due. That's 8 months away. Well, if you're paying 1/12, 1/12, 1/12, you have to have some money to start out with so that what you start out with in your escrow account plus what you pay each month is sufficient to meet the tax and insurance bills as they come due. So a couple other things to know with regard to your escrow account. Number one, even if you have a fixed rate loan where your loan payment is going to remain the same over the life of the loan, that doesn't mean that your total payment is going to remain the same. And the reason for that might be obvious. Your tax and insurance expense are not going to remain the same each year. They may go up, they may go down, they'll probably go up, but they're going to change. So every year, the mortgage servicer is going to do an escrow analysis to determine, are you putting enough money in that escrow account, or are you putting too much money in the escrow account, or not enough? It's analyzed every year because your tax and insurance bills change every year. Now, if your insurance and your taxes go up in the upcoming years, which is pretty typical as a new homeowner, then you're going to need to start putting more money into the escrow account. The mortgage servicer will usually give you some choices. You can make a lump sum deposit into your escrow account to equalize any increase that the account has incurred, or you can increase the 1/12 that you're putting in each month to catch up and then prepare for the upcoming bills. The other thing to know is that every year when you're sent that escrow analysis, and in fact, even when you close on a home and you're looking in your closing disclosure, you're going to see a line item called an aggregate adjustment. It's a negative number. It's a credit to you as the home buyer. What is that for? Well, the regulation says that a mortgage servicer cannot keep any more than 1/6 of your total tax and insurance bill in your escrow account as a cushion. It's really 2 months, but 1/6 is the way that the regulation is written. So when the escrow is established, computer software projects out 12 months, and invariably there will be at one point in the upcoming year where you have more than a 2-month cushion. That aggregate adjustment simply credits that money back to you. It's just a tool to make sure that your escrow account is not overfunded. Your money in your escrow account is always yours. So when you pay off your loan, maybe you sell the home or maybe you refinance, whatever is in that escrow account is going to come back to you. It's your money. So keep that in mind too. So I hope this is helpful for you. If you have any questions, please reach out to me. I'll put contacts in the link below. And remember, getting a mortgage doesn't have to be hard.